Welcome to Corporate Finance and our first lecture. Today we're going to talk about the time value of money. We're going to start off with some intuition, then I want to introduce the tools associated with the time value of money, namely the discount factor and the timeline. Finally, I want to apply those tools to move money back in time via a process called discounting. Let's get started. Hey everybody, welcome to Corporate Finance and our first lecture on the time value of money, and we're going to start off with some intuition and discounting. In particular, I want to give everybody a good sense of what the time value of money means in a context with which they're already familiar. Then I want to introduce some tools, and then I want to apply those tools to our first financial problems. So, some intuition. Hopefully in a setting with which everybody's already comfortable and familiar with, that's foreign currency. Imagine I've got 100 euros and $100, and I ask the question, how much money do I have? Well, we can't answer that, at least not yet, because we can't add euros to dollars, right? What we need to do is what? We need to convert the euros to dollars to find out how much we have in dollars, or convert the dollars to euros to find out how much we have in euros. And we do this using an exchange rate. And there's nothing special in this example that there's only two currencies. If I had three currencies, euros, dollars, and yuan, I would have to convert two of the currencies into one currency, one base currency, whether it's into yuan, dollars, or euros, using the appropriate exchange rates in order to answer the question how much money I have, or in order to add the different currencies. So what's the message? Well, look, we can't add or subtract different currencies. We have to convert the currencies to a common base currency using an exchange rate. So what does this have to do with the time value of money? Well, the time value of money refers to the fact that money received or paid at different times is like different currencies. You can't add it. Money has a time unit. What you have to do is you have to convert to a common base unit in order to aggregate it, and to do that, we need an exchange rate for time. So let's talk about some of the tools that we're going to use to accomplish this task. So first, the timeline, which is exactly what it sounds like. I've got a timeline here that lays out different time periods, and these periods could be anything. They could be years, they could be months, they could be days, they could be decades. Typically, we refer to time period 0 as today, or now, or the point at which we're answering the question. Okay? Underneath that, we lay out our cash flows, denoted by CF. The subscript denotes the time period, and this is nothing more than a visual representation of when money is coming or going. That's it. Get in the habit of placing cash flows on a timeline. When you work in Excel, it's almost automatically does that for you, but it's a great tool to emphasize the point that money arrived at different points in time has a different time unit and cannot be added, right? Don't add money at different points in time. Let me say it one more time. Never add money received at different points in time. Now I put a little asterisk there because some people will say, well, what if the money arrives very close in time? Then it's not such a sin, but get in the habit of just not doing it. And I say it multiple times because you'll do it, your friends will do it, people in finance do it all the time. But it's not a good thing to do, and you'll see why in just a moment. What we need is an exchange rate for time to convert to a common time unit, and that exchange rate is called a discount factor. Our discount factor is given by 1 plus r raised to the power t. T, that's just the number, the time periods into the future, if t is greater than 0, or past, if t is less than 0, that we want to move the cash flows. R, well, that gets its own slide. R is the rate of return offered by investment alternatives in the capital markets of equivalent risk. And that's a mouthful. R goes by several other names. It goes by a discount rate, a hurdle rate, an opportunity cost of capital. The way to think about R is just to ask yourself, what are the risk, or how risky are the cash flows that I'm going to be discounting here? And then think about how that relates to investments in the capital markets. So what I've done here is I've presented average annual returns to six different investments. And what do you see? What do you notice? You notice that riskier investments, as I move down the columns, riskier investments are met with higher returns. Riskier investment, higher return. Okay. All So how do we use the tools? Well, we're first going to focus on bringing cash flows back in time. And when we move cash flows back in time, that's called discounting. And so here's my timeline that we started out with. And I'm simply illustrating that if I want to convert all of these cash flows from period 1 forward into time 0 units, what I do is I apply my discount factor, right, to each one. So to move cash flow 1 back to period 0, I'm going to multiply by 1 plus r to the minus 1 because I'm moving it back in time, hence it's negative, 1 period, hence 1. And similarly for cash flows 2, 3, and 4. Right? Again, notice that all of the exponents are negative because we're moving all of these cash flows back in time to today's units. Right? Once I've done that, once I've discounted each cash flow back to today, I can add all of these numbers. Right? They're all in the same time units, namely date 0 units. Let's get rid of this mess. These values of the future cash flows as of today are called present values. Present values of cash flows is the discounted value of the cash flow as of period T, or in this case, period 0. And the notation is just that. Present value as of period 0 of cash flow 1. Present value as of period 0 of cash flow 2. It's just some notation that'll be useful as we move throughout the course. Let's do an example. How much money do you have to save today to withdraw $100 at the end of each of the next 4 years if you can earn 5% per annum? The first step in tackling any problem is to just put the cash flows on a timeline. Let's get our bearings straight, right? The question is, how much do I need today? So how much do I need today, period 0, if I'm going to withdraw $100 each year over the next 4 years thereafter? Okay? Well, the naive thing to do would be to just add these and say $400. But we know that's wrong because that's a no-no. These cash flows, or these dollar amounts, have different time units. We can't add them. What we need to do is move them back in time today by discounting. And since we've assumed a 5% discount rate, or a 5% rate of return on our investment, that's our R. And you'll notice I'm dividing each one by the discount raised to the appropriate power. We can do a little arithmetic, and now I can add all of these numbers. They're all in the same time units to answer the question. We're going to need $354.60. More precisely, we need $354.60 today in an account earning 5% each year so that we can withdraw $100 at the end of each of the next 4 years. Alternatively, the present value of $100 received at the end of the next 4 years is $354.60 when the discount rate is 5%. Now, I know that's just another way of saying what I said in one, but get in the habit of different words meaning the same thing. Finance is just laden with jargon, and the sooner you get used to it, and the more exposure you have to it, the more comfortable you come with it. With that segue, interpretation 3 is today's price for a contract that pays $100 at the end of the next 4 years is $354.60 when the discount rate is 5%. 3 different ways to say the same thing. Okay. All right. Now, I want to mention, we're assuming that the discount rate R is constant over time. See, when I pull back each cash flow, I discount each one by the same 5%. That's a common assumption, but I want to emphasize it's still an assumption, one we're going to look at when we talk about the term structure of interest rates and yield curves later on. Okay. But what's going on in the background? How is this working? What's actually happening on a dynamic basis? Well, at time period 0, we're inserting or depositing $354.60. Okay. Then we're going to earn interest at 5% on that money, which is going to amount to $17.73. $17.73. And I'm assuming all the activity happens at the end of the period. It just makes things a little bit easier conceptually. There's nothing special about that. We can make the period shorter, which we will later on. Okay, so I earn my interest, right, which is the $354.60 times the 5%. Okay, that's going to give me a pre-withdrawal balance of the initial balance plus the interest. But notice that's just the that the present value of that amount, the present value of this 372.32, is just our initial withdrawal balance. That's our 354.60. I'm going to pull out $100. That's going to leave me with 272.32 after the first year. And if we continue this process for the next 3 years, 2, 3, and 4, what we see is we're going to exactly offset or exactly exhaust the funds in the account. Okay, so let's summarize what we learned today. Rule number 1, never add or subtract cash flows from different time periods. You'll want to do it, don't do it. What we need to do is recognize that money has a time unit. And in order to add money at different points in time, we need to convert that money to a common base unit using an exchange rate for time called our discount factor. We're also going to get in the habit of using a timeline to get our bearings straight, a visual representation of when money is moving in or out. And we learned about the present value of a cash flow. Right? It tells us the value of future cash flow as of some time period, some earlier time period. It also tells us the price of a claim to those cash flows. And what's coming up next, we're going to go in the other direction, moving cash flows forward, in other words, compounding. Thanks for listening, and I look forward to seeing you in the next lecture.
Welcome back to Corporate Finance. Last time we introduced the time value of money. We started with some intuition. We introduced the tools, namely the timeline and the discount factor, and then we showed how to move money back in time via discounting. Today, I want to go the other direction. I want to move money forward in time via a process called compounding. Let's get started.
Hey everyone, welcome back to Corporate Finance. Whoa. Today we're going to be talking about compounding, but let me start off with a brief recap of what we did in the last lecture. Last time we introduced the time value of money, the concept. We started off with some intuition and showed that money has a time unit that prevents money arriving at different points in time from being aggregated or added together. Then we introduced some tools associated with the time value of money, notably the timeline, which is just a visual representation of when money is moving in or out, and the discount factor, which was our exchange rate for the time value of money. It allowed us to convert the time units on money, moving it forward or backward. And then we applied those tools to move cash flows back in time via discounting. And the big lesson was don't add cash flows with different time units, ever. Today I want to go the other direction and talk about compounding or moving cash flows forward in time. So let's get started. Okay. So compounding just refers to moving cash flows forward in time. And here's our familiar timeline. And what I'm doing is I'm taking each cash flow CF0, 1, 2, and 3, moving them forward to period 4 via compounding. So, focusing on cash flow 2, I move that forward to period 4 by taking cash flow 2, multiplying it by my discount factor raised to the power of 2, because I'm moving it 2 periods forward, and it's positive because I'm moving it forward. Okay. More generally, all of the exponents are positive, again, because we're moving all of the cash flows forward in time. Now, I can add all of these cash flows now because they're all in the same time units, namely, right, I can add all of these cash flows. They're all in date 4 time units. Now these cash flows, once they've been moved forward, are referred to as future values, right? So again, this is just notation like with present values. This is the future value as of period 4 of cash flow 3. The future value as of period 4 of cash flow 2. And likewise for cash flows 1 and 0. Let's do an example. How much money will I have after 3 years if I invest $1,000 in a savings account paying 3.5% interest per annum? Well, step 1, put down a cash line. Put down a timeline. Okay, put the cash flows on a timeline. So I'm going to invest $1,000 today, period 0, and the question's asking how much money will I have in 3 years? Well, all we're going to do is move the cash flow forward in time by compounding. I'm going to multiply by 1 plus r, where r is 3.5% in this case, and I'm moving the cash flow 3 years forward in time, so that's a positive 3 exponent on my discount factor. Right. If we do the arithmetic, we get that the $1,000 is worth $1,108.72, or just under 72 cents. Right? And I should also mention that this is just the future value of the 1,000. In particular, it's the future value as of period 3 of the cash flow in period 0, which was $1,000. Okay. Let's do a second example. How much money will we have 4 years from today if we save $1,000 a year beginning today for the next 3 years, assuming we earn 5% per annum? Step 1, put the cash flows on a timeline. That's exactly right. So we're saving $100 a year beginning today for the next 3 years. We're going to earn 5%, and I want to know how much I have after 4 years. Well, to do that, we're going to have to move each cash flow forward in time to period 4. So look at the cash flow in period 3. I need to move that forward 1 period, so I multiply by 1 plus r raised to the positive power 1. We're going forward 1 period. Cash flow 2 has to go forward 2 periods, so we're going to multiply that by our discount factor raised to the power positive 2. And likewise for cash flow the cash flows in period 0 today and 1 year from today. Okay. If we do the arithmetic, we get these future values of the cash flows, right? 105, 110, 115, 121. We can now add all of these cash flows because they're all in the same time for period 4 time units. Okay. And if we do that, I get 452.564. So what does this mean? How do we interpret that? Well, we will have $452.56 at the end of 4 years if we save $100 starting today for the next 3 years and our money earns 5% per annum. Interpretation 2. The future value 4 years from today of saving $100 starting today for the next 3 years at 5% per annum is $452.56. Okay. So what's going on here? What's going on behind the scenes? Well, we're going to deposit $100 today. That's going to earn 5% interest and give us an additional $5 at the end of year 1. So our pre-deposit balance, that's before our next deposit, is just $105, which, by the way, is also equal to the future value 1 period hence of the $100, right? The future value of this $100 1 period hence is just the 100 times the 1 plus r to the 1. I deposit another $100, and I've got $205 after the first year. We continue this process for 4 years, and lo and behold, we're left with $452.56 at the end of the 4th year. More generally, there's nothing special about moving the cash flows to the end of the timeline or the beginning. You can move them anywhere, just as long as you're consistent. We can pick any point in time, such as period 2, and I can move cash flows 3 and 4 back in time, right? By applying a discount factor raised to a negative value, I can move the cash flows today and the cash flow 1 year from today forward in time by applying a positive exponent to the discount factor. And now these cash flows here are all in the same time 2 period units. All right, so let's summarize this up. We use compounding to move cash flows forward. We apply a discount factor with a positive exponent to move them forward in time, and that gets us future values. Okay? So what I want to see you do now is work on the problem set. Okay? And then coming up next in our next lecture, I want to talk about some useful shortcuts for present value and future value of common streams of cash flows. So thanks again for listening, and I look forward to seeing you in the next lecture.
Welcome back to Corporate Finance. Last time, we talked about compounding, or the process of moving cash flows forward in time. Today, I want to present several useful shortcuts to compute the present value and future value of common streams of cash flows that we see often in practice. Let's get started.
Hey everybody, welcome to our 3rd lecture on the time value of money. So last time we talked about compounding, or the process of moving cash flows forward in time to find their future value. Whereas in our first lecture, we moved cash flows back in time via discounting to find their present value. So what I want to do today is I want to give you some useful shortcuts for computing the present value or the future value of some streams of cash flows that commonly arise in practice. So let's get started. The first thing I want to talk about is an annuity. An annuity is a finite stream of cash flows of identical magnitude and equal spacing in time. And I've highlighted key elements of this definition. So here's a timeline representing an annuity. First key aspect or feature of an annuity are cash flows of identical magnitude. These are all of these cash flows are the same number. Okay.
Okay, so identical magnitude. Secondly, this is a finite stream of cash flows. It ends at some point in time. Okay, and that might seem like an unnecessary or obvious assumption, but you'll see that we'll deal with infinite cash flow streams in a little bit. And then the last assumption is that the spacing between the cash flows has to be equal. So it's always a year. We always get the cash flow after 1 year, 2 months, whatever that spacing it is, it has to be the same. And it turns out that this cash flow stream arises in a number of situations in practice. So insurance companies sell a product called an annuity, representing its cash flow stream. Home mortgages are an example of an annuity stream. Auto leases, certain bond payments, and amortizing loans are annuities. So it's actually fairly common in practice. Now, if we wanted to find the present value of these cash flows, we know how to do that, right? We can brute force it. We can take each cash flow and discount it back to today, right? So imagine I had a second cash flow. The second cash flow here, I could go CF divided by 1 plus R squared. That would bring it back to today. I could take this cash flow, CF over 1 plus R to the T minus 1. That would bring it. And I do that for all the cash flows, and then I could add them up here. And that would give me the present value. But that's a bit burdensome, especially when T is big. Okay. So what I'd like to show you is a shortcut or a simple formula to compute the present value of this cash flow stream, and here it is. We take the cash flow, CF, we divide it by the discount rate and multiply it by this term in parentheses here. Now if I move the R over here, I can re-express the present value of the annuity formula as just the annuity cash flow times this term here, which is called an annuity factor. Okay? That will give me the present value of this cash flow stream. One thing to keep in mind, though, is that in order for this formula to make sense, not only do all the features defining an annuity stream have to be true, but we're assuming that the first cash flow arrives 1 period from today. So for example, if my cash flow stream looked like this is an annuity stream of cash flows, but this formula is not going to give me the present value of this cash flow stream. Actually, what I would have to do is I could just add CF, right? Because this is the present value. It's coming today. Okay. Let's do an example. How much do I have to save today to withdraw $100 at the end of each of the next 20 years if I can earn 5% per annum? Well, step one is draw a timeline. I'm trying to figure out how much I have to save today in order to pull out $100 every year over the next 20 years. Well, we know how to do that by brute force. We can simply discount all of the cash flows back into today's time units and add them up. A more elegant solution that we just learned, of course, is to apply our present value of annuity formula. Right? The cash flow is 100 CF. The discount rate R is 5%. And the time of the cash flows is 20 years. Plugging all those numbers into the formula and computing, we get the present value of these cash flows is $1,246.22. That's how much money I have to save today in order to withdraw the $100 every year. Now let's turn to something called a growing annuity, which is, as the name suggests, just like an annuity, but for the fact that the cash flows are growing. So it's a finite stream of cash flows, okay, evenly spaced through time. Okay. But now the cash flows aren't constant, they're growing at a constant rate, G. Okay. And this type of cash flow stream pops up in a number of instances in practice. Certain income streams, for example, your work, right? You might imagine that your work your salary grows at some constant rate G, or approximately some constant rate G. Certain saving strategies, maybe you want to save a certain amount each year, but you want that amount to grow with your growing income stream. In corporate finance, certain project revenue and expense streams will often grow at a near constant growth rate. So it's a really useful approximation to many cash flow streams we'll come across in practice. And like our annuity stream, we can represent the present value
of this cash flow stream with a simple formula as follows. We take the cash flow as of the first period divided by the discount rate less the growth rate times this factor here. That will give us the present value of this cash flow stream right here. Okay? But remember, a critical assumption is that the first cash flow arrives one period from today. Okay? Let's do an example. How much do we have to save today to withdraw $100 at the end of this year, $102.50 next year, $105.06 the year after, and so on for the next 19 years if we can earn 5% per annum? Well, let's draw a timeline, and what we see is that our first withdrawal of $100 occurs 1 year out, then 102.5, and on and on and on. What we can discern from this problem is that these cash flows are growing at a constant rate G equal to 2.5% per annum. Okay? So this cash flow stream satisfies all of the requirements needed to use the present value of a growing annuity formula. So our first cash flow of $100, our discount rate of 5%, and here's our growth rate of 2.5%. That's going to get us a present value of $1,529.69. That's how much we would need to withdraw $100 growing at 2.5% every year. Okay. Now let's talk about a perpetuity. So a perpetuity is just like an annuity except the cash flows go on forever. Right? We get the same amount of money, equally spaced in time, forever. So where does this thing come up in practice? Well, oddly enough, it actually does in something called perpetuities or console bonds, which exist over in the UK. And interestingly enough, the formula for this cash flow stream is very simple. It's just the cash flow divided by the discount rate, CF over R. Let's do an example. How much do you have to save today to withdraw $100 at the end of each year forever if you can earn 5% per annum? Well, the timeline looks as follows, right? $100 every year forever, and clearly the brute force method of discounting each cash flow one at a time is never going to work. It's just impossible. So we have to use our formula. We take the $100 divided by the discount rate of 5%, and that gives us $2,000. We need $2,000 to be able to withdraw $100 a year forever, assuming that money can earn 5% per annum. And intuitively what's going on is once we get out 100 years, 200 years, whatever, the present value of that money is so small it's very close to zero, which is why you don't need an infinite amount of money. And the perpetuity's cousin, a growing perpetuity, is just that. It's an infinite stream of cash flow that grows at a constant rate, G, and that are evenly spaced out through time. Okay. So here's a visual representation. Here's our timeline of a growing perpetuity. What's an example of a growing perpetuity in practice? Well, dividend streams are much like a growing perpetuity. They're a useful approximation. Don't take it literally. Companies don't last forever, but we can treat them as such because there is no finite end date to most companies, absent some event such as a bankruptcy or an acquisition or a takeover, something like that. So what's the formula for a growing perpetuity? Well, it's just the cash flow that we're going to receive in the first year divided by the discount rate minus the growth rate of that cash flow. Again, we're going to have to assume that the first cash flow arrives 1 year from today to use this formula, as well as having all the other requirements being satisfied, the cash flows being evenly spaced and them growing at a constant rate. So let's do a little example now. How much do you have to save? How much do you have to save today to withdraw $100 at the end of this year, 102.5 next year, 105.06 the year after, and so on forever if we can earn 5% per annum? Well, let's draw our timeline. So we're going to get $100 here in year 1, 102.5 in year 2, that's growing at 2.5%, as is the 105.06 if I had written it here. So our G
is 2.5%. The first cash flow comes 1 year from today. There's our first cash flow. This goes on forever, and the spacing is equal. So this is a growing perpetuity to which we can apply our growing perpetuity present value formula. So we take the first cash flow, $100, divide it by the difference between the discount rate and the growth rate to get $4,000. In other words, if we have $4,000 today and it's earning 5% interest per annum every year thereafter, we can pull out $100 next year and have that amount grow by 2.5% every year thereafter. All right, so let's summarize. We learned a couple of useful shortcuts today. We talked about an annuity and its present value formula. We talked about a perpetuity and its present value formula. We talked about their growing cousins, the growing annuity and the growing perpetuity and the present value formula for those guys. And while that might seem somewhat esoteric and bland or boring, we also discussed some of the applications that you might see in practice, these cash flow streams arising. Okay? And where these shortcuts are really useful, more than just finding the present value or the future value, is in finding the cash flow associated with the stream. So being able to manipulate these formulas is very important. And so in the problems, you're going to spend some time in real life contexts, or at least as close to real life as we can get, manipulating these formulas to derive certain aspects of interest, whether it's the cash flow or the amount of time or the discount rate or the growth rate. Right? So tackle the problem set. It really brings the material to life. But be very careful that applying these formulas takes care. Don't blindly apply them to any setting, because as we discussed, certain characteristics of the cash flows have to be met in order to, or certain requirements of the formula have to be met in order to use it. So good luck with the problems.
Welcome back to Corporate Finance. Last time we talked about some useful shortcuts to compute the present value and future value of cash flow streams that we commonly come across in practice. Streams like perpetuities and annuities, and growing perpetuities and growing annuities. This time I want to shift gears and talk about taxes and their impact on our dollar returns. Let's get started.
Hi everyone, welcome back to Corporate Finance. Last time we talked about several useful shortcuts for computing the present value of a cash flow stream. We talked about annuities and perpetuities and growing perpetuities. And we also discussed that these cash flow streams were representative of cash flow streams we might find in practice. What I want to do now is I want to shift gears and talk about taxes. In particular, I want to talk about how taxes impact our discount rate or our cost of capital, and ultimately how they impact our dollar returns. So let's get started. So I want to start with a little bit of motivation. I know we don't have a lot of time, but it's worth mentioning a few things. This is a picture of the top statutory tax rate on different sources of income, in particular dividends, which is the blue line, capital gains, which is the red line, and interest income, which is the green line. And I don't want to make too much of this picture, but I just want to emphasize a couple of things. First, you should see that the tax rates are moving all over the place. There's an enormous amount of variation in taxes over time, number one. And number two, you can see that historically, right, tax rates have gotten really high. Now, admittedly, it's not clear how many people those tax rates of 90-95% actually applied, but taxes are substantial and they move around a lot over time. So it's important to understand how they impact our investment income. Okay. So let's illustrate this by example. And I want to revisit an example we looked at in the past, in particular in our first lecture on discounting. So the question is, how much do you have to save today to withdraw $100 at the end of each of the next 4 years if you can earn 5% per annum? Well, recall, the first thing we do is we lay out a timeline. And here are our cash flows, right?
we're going to be withdrawing $100 a year over the next 4 years, and the question's asking how much do we need today. So what we did is we discounted each cash flow, each of the $100, by the 5% discount rate to get the present value. So for example, we took this first 100 divided by 1 plus 0.05, and that got us $95.24 approximately. Then we took the second cash flow, 100 divided by 1 plus 0.05 squared, that's a 2. And that got us the second cash flow, and on, and then we could add these cash flows because they're all in the same time 0 units, and that produced our answer of $354.60. Okay. Then when we thought about what was going on in the bank account, recall, right, we would insert $354.60 into the account. It would then earn interest at 5%. Right? We'd add that to the previous balance. Then we'd pull out some money, and that would reduce our balance. And we would continue that for 4 years. At the end of the 4 years, we would be left with nothing. But now consider what happens when we have some taxes. See, now we put our $354.60 into the account. That earns interest at 5%. But now we have to pay taxes on that interest income. And I'm going to assume the tax rate we're facing is 35%, which isn't too far off from the top statutory rate currently prevailing. Okay. So that 35% of the 1773 is $621 in taxes. That's going to reduce our pre-withdrawal balance, okay, to $366.12. Then we pull out $100, and then we're left with $266.12 at the end of the first year. Okay. Which, by the way, the $266.12 is less than the $272.32 because of the taxes. Now, if we continue that process, we'll get down to 0, but only because in the last year we can only pull out $83.06. That's all we have left in that last year. Okay. All right. So on net, we're $16.94 short. The taxes are reducing the funds available for withdrawal. We're running out of money early. Right. So the lesson here is that taxes reduce the return on our investment, the dollar return on our investment. And one way to account for that is an after-tax discount rate. I'll call it RT. And that equals our usual discount rate times 1 minus the tax rate. Okay. So for our example, the discount rate R was 5%, and the tax rate T was 35% for an after-tax discount rate of 3.25%. Now let's revisit the problem using this after-tax discount rate. So now when I discount all of these cash flows back to today, I'm going to use RT, which equals 3.25%, instead of the R, which equals 5%. When we do that, when we do the arithmetic and add all these numbers up, we get $369.50, a number that's bigger than the $354.60 we originally found with the 5% discount rate. Now let's run through the exercise of looking at what happens to the savings account. So now we put in $369.50. Okay. That's going to earn interest at 5%. We're going to pay taxes on that interest at a rate of 35%, which generates a pre-withdrawal balance in the first year of $381.51. We pull out the $100, and then we're left with $281.51. We continue that process for a few more years, and at the end of 4 years, we're left with nothing in the bank account, and we've been able to pull out $100 each year. So what's the implication? Well, we need to save more to withdraw $100 per year after taxes, right? In particular, we need to save $369.50 as opposed to the $354.60. And it's also interesting to note that the difference in how much we had to save, the difference between the $369.50 and the $354.60, which equals $14.90. That equals the present value of the taxes at 5%. Check this. Discount these cash flows at 5% and see what the present value is. It should be $14.90. Okay, let's summarize this and bring it back together. Taxes reduce our dollar return. The after-tax return is less than the pre-tax return, okay? And it's less by a factor of 1 minus the tax rate that you're facing, okay? So we can discount by this after-tax return to see how much money we're going to have once we've swept out the effect of taxes. And given tax rates in the US, not to mention most of Europe and many other countries, taxes are significant and can have a huge impact on our cash flow streams, our savings behavior, and ultimately our decision making. So looking ahead, I want you to dive into the problems, work on the problem set, and then we're going to look at inflation and investigate how inflation affects our cash flow stream and our decision making. So thank you, and I look forward to seeing you in the next class.